President Trump's nomination of Kevin Warsh as the next Federal Reserve Chair has stirred up a lot of discussion. It's too early to declare a regime change, but the direction is clear. More restrictive, structurally hawkish Fed is now back on the table. Welcome back to A View from the Street. I'm Mike Drozd, CIO for LaSalle Street. Stay tuned to learn what the changing of guard at the Fed could mean for markets and the economy. Based on our initial analysis, Warsh brings a less interventionist view of the Fed. It's leaner and more accountable to the real economy. This marks a break from the recent run-it-hot era and an expansionary balance sheet policy of quantitative easing. Warsh also expects AI to push inflation lower, even if it lifts the neutral rate. In our view, AI may create a jobless recovery dynamic, keeping the neutral rate lower. And it appears that Warsh would end the reflex to tighten on strong labor data and instead respond more aggressively to fiscal expansion. This also means a meaningful balance sheet reduction, bringing tighter liquidity and the likely end of the QE era liquidity regime. This also means shifting power to regional banks, aiming to redirect credit creation toward the real economy. Also, a focus on a treasury-anchored system fundamentally reshapes liquidity and long-term yields. While it's still early and the ultimate impact on monetary policy remains uncertain, it's clear we are moving through a transition. As we outlined in our 2026 outlook, the intersection of monetary and fiscal policy, rising geopolitical pressures, and accelerating structural shifts are all shaping a new macro regime, one comparable to prior fourth turning periods. Near-term volatility may be inevitable, but the long-term trajectory points towards a healthy and more resilient foundation for the U.S. economy. Thanks for tuning in, and for more information, please reference our most recent CIO Perspectives publication or reach out directly. Thanks again.